Welcome back, Yield Nerds, episode 115. And this time, we're going to talk about the real secret of smart investing, which is asset allocation. We'll see all about what that is. And here is a young man allocating his assets among a handful of different options. We'll learn all about that. And I'm going to take a victory lap. I'll tell you more. Well, we're up to 285 subscribers. Thank you again for your support. We've been at it for about a year and something, I would say. And in that meanwhile, if you are new to this show, please make sure that you check out our playlist. The playlist organizes the content from the beginner level all the way to where we are today. Most importantly, I can't pull a rabbit out of a hat full of gold coins like this wonderful man here. I have no magical powers of prediction. I'm sharing my education. Make sure that you do your own homework. Okay, the agenda for today has 4 parts. I'm going to take a victory lap of how a blind squirrel got a nut. CalMaine Foods, how about that? We'll talk about what happened. And if you haven't watched the previous episode, I make some statements regarding CalMaine Foods. Magically, everybody gets lucky, I guess, and I got lucky once. Second thing is around asset allocation, the crux of today's discussion. And I will be unveiling another lunch money pick, another equity where my assessment of macroeconomics and microeconomics tell me that there may be an opportunity. Remember to do your own homework. And then I'm going to review a little Schwab feature which will help you beat yields. Trust me. Okay, CalMaine Foods. So this, as you know, is a producer of eggs, the largest producer in the United States. And they were roaring and they crushed their earnings, and we'll find out what really happened. And they said, and if you haven't watched the previous episode, please do. They said, hey, by the way, our feed costs were down. And where do you think that 20% goes? It goes directly to their bottom line, increases their profitability. Plus, they talk about specialty eggs, and sales of specialty eggs increased. Specialty egg is fancy for, free range chicken, things like that, organic eggs, free range eggs. Those sell for a higher price. And the faster CalMaine converts their sales to specialty eggs, not only will their revenue will grow, their margin will also grow. And that is what they're doing. Nice job. And I'm excited about it. What did I really take away with? If you go to their website, CalMaine Foods Investor Overview or About Us or Specialty Eggs, you will see that what you and I may think are completely different brands are all actually CalMaine Foods. Eggland's Best, Landolakes, and this one is Farmhouse Eggs, and all of these different brands, they are all CalMaine Foods because they have been prolific in acquiring egg farms and then converting them into free range and organic and increasing their margins. Amazing company, in my opinion. Please do your own homework. So CalMaine worked out very well for me. And now we'll come to the crux of what we came here for today, which is asset allocation. So how do you think about, where you want to park your money? That is ultimately what asset allocation is about. I enjoyed reading this investment outlook by Invesco. I have no financial relationship with Invesco. I don't do product pitches, and I don't have any affiliation sponsorships, to be clear. I read investment outlooks from many different people. Invesco is one that I follow, and they talk about how do you invest right around the first cut. And right around the first cut may mean 3 months, it may mean 1 month. We're kind of sort of somewhere between 0 and 6 months, I would say. And they then show how various asset classes perform the 12 months before and the 12 months after. And surprise, surprise, real estate and commodities roar leading up to a rate cut, and they go flip the other way as we approach the rate cut. And as you can see, that's kind of happening right now. The important thing to note is equities will see a surge, and we already are seeing a surge in equities, but in theory, when the first rate cut comes, equity should go even higher, while government bonds should go lower. The reason being, if interest rates are going lower, then you probably would be tempted to not hold those bonds anymore, and that's kind of the theory there. The notion that corporate investment grade bonds would go higher is assuming that investment grade bonds pay a higher yield than government bonds. And as you know and I know, if you have played the yield Super Bowl at all, Today, that equation is not being met. So in my humble opinion, this economic cycle, we are not there. High yield, same thing. There is really no premium today for holding any of those. Government bonds do just fine, at least at the moment, but we should just be aware. Having said that, there are additional articles again at Invesco that I look for tactical things, just advice to see. It doesn't mean I do it. I kind of, do some homework. And here is an article by Alessio De Longis. He's a CFA, a senior portfolio manager. Thank you, Alessio, for your wonderful work. And if you Google tactical asset allocation by Invesco, here's what Alessio recommends. And it doesn't mean I agree. I'll tell you where I am compared to this. But Alessio wants you to give up fixed income, go towards equities. And this article is dated March 1st. So it is very, very recent. And Alessio would like for you to go full tilt on equities and actually just half and half on US, but goes farther and farther towards emerging markets and cyclicals. And he does recommend buying value and small cap over large cap. Interesting. Thank you, Alessio. And in terms of duration, he recommends spreading your duration and laddering. And he says, get out of these US treasuries and go into developing markets and go buy bonds in India, in China, and so on. I don't know. That's Alessio's recommendation. Alessio seems to think we should hold TIPS. To be clear, TIPS pays when we are in an increasing inflation environment. And if the rate of increase is not high, then you don't make a lot of money on TIPS. So according to Alessio, the rate of inflation in the US is going to be higher and higher. You do your own math. When I look at my portfolio, Alessio, I am in the other extreme. I am not overweight on equities. I'm very overweight on fixed income. And in terms of developing markets, I am all US. And so I'm kind of on the other extreme. Having said that, there are several areas where I'm right in with Alessio. I'm on the cyclical side. I'm on value side, all in on value. I'm very heavily, there is a filter I use called Magnificent Seven. I don't intend to limit it to value stocks or small caps, but it just turns out when I apply my criteria, they tend to favor Russell stocks, and that's just the reality. I also align with Russell on if I buy credit, it's going to be government credit. I have a little bit of risk allocation, not a lot, like Alessio is recommending. My ETFs, BISD and SRLN, which is bank loans, they are risky, but I don't have a very big allocation. I have about 10-15% allocation because they pay a lot of dividends. In terms of duration, I'm certainly far left of what Alessio recommends. And I'm very, very heavy into US Treasuries, as you know. So the thing that I take from Alessio, in the rear view mirror, in Q1, if I had followed Alessio's asset allocation strategy, I frankly would have come out better because Q1 equities roared. My instinct, for Q2 is I'm not sure. I mean, this is a Cinderella scenario for this allocation to work in Q2. So Alessio, will see how it works out. Having said that, here is my strategy. I most importantly live within my means, which means every month I have excess income and I take that excess income and put it to work. And I gently increase my allocation to equities as long as it meets my filter. Otherwise, I don't go there. And I know around the rate cut, when I see that there is some turbulence, I intend to increase it. And I do intend to increase duration, but a little bit slowly and not jumping into it. And as far as credit, I have no interest in junk bonds and things like that. I do have, SRLN and BISD, which are, low credit, but that is about as far as I will go. Speaking of which, here are my trades. I bought some TK tankers. We're going to talk about why I bought them here in a second. And then a whole bunch of treasuries. I bought some CalMaine Foods. We already talked about why I bought CalMaine Foods. And Encore Wire, which is betting on the copper price side of the house. And we'll talk more about that as well. So now let's talk about the next lunch money pick. Meaning, here is an educated guess from me, and you have to do your own homework in terms of allocating some capital. And that is based on my infamous Magnificent Seven value filter. Here is how the filter works. It only looks at domestic stocks at high volume. And, profit margin. I asked for a minimum of 15% profit margin, low debt, high cash flow per share. I don't want to pay a lot. I want low price to earnings. I'd like some dividends and price to cash flow. If it generates cash flow, I don't want to pay a lot for every dollar of cash flow either. And drum roll, here comes the magnificent seven. It doesn't have to be seven. It could be more than seven. Are you ready? Bada bing, bada boom. Before I go there, I need to make sure I am not a wealth management advisor. I'm not offering you investment advice. I'm sharing what I learned. You make your own decisions, and I'm not here to endorse products. So having said that, here comes the next call from the blind squirrel. From the one and only magnificent seven value filter, here are the results of that same filter. And if I sorted it by PE ratio, the cheapest PE ratio stock with a huge profit margin, low debt, high cash flow, and you only pay $3 per dollar of cash flow, and they have plenty of money to cover dividends, is TK Tankers. And then there is another one that catches my eye, which is Chesapeake Energy. And their PE ratio is 5, which is still pretty good, and they have a healthy profit, and their coverage ratio is high, and you're not paying a lot for the dollar of cash flow. And you may remember I already own CEIX, and I own several of the others, so I'm only going to focus on these two, and we'll dive deeper. First, we're going to start with Chesapeake Energy. I'm showing you their own annual report, and this is the guidance they gave at the end of 2023, leading into 2024. And they said, we own a lot of fracking wells in the Marcellus Shale and Haynesville Shale, and those wells are underperforming. And as a matter of fact, we will be shutting down half of those wells. Production will be down. As a matter of fact, in Q1 2024, production was down in half of those wells. And for the rest of the year, they will continue to be down. And we also are not even digging new wells there because we are decreasing our capex in those areas. And that is what Chesapeake Energy has to say. They are going to go buy Southwest Energy, and that is where they are headed. Once they have decreased their guidance like that, you would expect their stock crashed. Did it crash? Well, it did when they gave that guidance, but apparently none of it matters. The stock has recovered completely, and so it is as though all of these wells are still functioning. This is my read, you do your own math, but Chesapeake Energy has excellent cash flows, but management is warning that their revenue is going to go down, and the market somehow is looking the other way. At least that is how I see it. So not for me. I'm going to pass Chesapeake, and I'm going to go to TK Tankers. I have owned TK Tankers before. I sold it at a profit, and I'm going to look at it again. Here comes their revenue. It went up, and it started falling down. That is why I sold TK Tankers. Their earnings has a very identical pattern, up and down. Cash flow has a very identical pattern, and you have to sit there and say, gee, I wonder what is driving this. TK Tankers transports oil and LNG, and their price directly follows the crude, WTI crude. And so the blue line is the daily price of crude, and the black line is the moving average. And as you can tell, the black line smooths it out. And the blue line, however, the day of the Ukraine invasion, crude price shoots up and then it comes down. And so if you don't want that distraction, you can follow the moving average of crude and then compare it to TK Tankers stock price. How about that, or rather their revenue? As you can tell, and I lined up the years just so you and I can see it better, here are the lines separating each of the years. And you can literally see that the slope of WTI crude is the same as the slope of their stock. As a matter of fact, this hits an all-time high right around Q1 2023, and it starts going down. And if you were to look around the 2024 Q1, you can see that the moving average kind of flattens out, and the daily price is actually on the uptrend. And when TK Tankers gave guidance, they said, sorry, folks, we blew it. Our revenue in Q4 was less than our revenue in Q4 the prior year, and their stock crashed, and then it kind of started recovering. And in the meanwhile, the WTI price is going up. And so then you have to say, gee, If the moving average is kind of sort of flat, what do you think their revenue will be? And you have to look here and say if it was 300 and it was generally flat, the correlation in the past is pretty good to the WTI moving average. I don't know, an uneducated person like me, I don't know crude prices from a hole in the wall. I kind of look at a line and I say, well, maybe it'll be around 300. Well, then I can say, but the daily price is actually trending upwards, so maybe it should be more than 300. And you look at when they gave guidance, they gave their guidance at the low of the low, and look at that. Their guidance is a 33% drop in revenue while the market is going the other way. Here is my conclusion. You do you. Remember, the guidance date was at the low of the low, and it tracks the WTI moving average. My sense is that the earnings forecast was given at a low of crude. This is not Chesapeake Energy where they are saying we're shutting down wells and the stock still goes up. This is one where it depends on traffic and demand and price. Increase in crude price is favorable to the revenue of TK tankers. Geopolitical risks, we saw what happened with the Ukraine war, and right now there are a couple of other developments in the news that I think cause concern. And there are bridge collapses, there are tankers that are blocked. Anytime a tanker doesn't dock and empty the crude, TK Tankers gets to charge rent, so to speak, because the tanker is busy. And so if there are problems with trade, if there are problems in canals, TK Tankers revenue goes up. Climate disasters, there are severe rains, there is flooding, you close the port. Well, TK Tankers calls it cha-ching because the oil stays longer in their tanker and they charge more rent. All of this happened since their earnings date and the previous guidance date. Make your own call. I bought TK Tankers for that reason. Now I'm going to go to the very last part, which is a Schwab feature. I call it feature within quotes. So if you were to look at Schwab and you look at bonds and fixed income, you will see that the 3-month is give or take 5.35. Well, if you click on that particular blue button, you will see indeed that the highest yield, this is sorted in the descending order of yield when you click that, the highest yield is 5.35. You say, what the hell are you saying? What news do you have? Hold the thought. Then you can go click on modify search and say, maybe I don't want to buy 3 months. And when you click on that modify search, here's what I did. I said, tell me everything you have for this year. You can say everything you have for the next 5 years, it doesn't matter. And say, now tell me what do you have? And you would imagine if the 3-month is 5.35, we should get at least 5.35. Nope, you get 5.31. And you go, wait a second. I know there is a 5.35. I just saw it a moment ago. How come that is not there? Well, it turns out whenever you use the modify search button, results are not sorted in the descending order of yield. So now you have to go click the yield to maturity and sort it in descending again. Surprise, surprise. You now suddenly find securities that have even a higher yield than what is published in their dashboard. And one part of the reason why is because this is not even 3 months, it's less than 3 months, and there is no place for Schwab to park it. But it turns out if you don't care about holding it exactly 3 months, you can even beat the 3-month yield and get 5.379%. I hope you enjoy that additional 0.2% yield, which is really 5% of your yield. So here is a summary of my moves. I do expect interest rates to go down, but I'm in no hurry. I'm just taking short-term, really short-term, positions in treasuries. As I get closer to the election, I'll assess what to do. For now, I'm staying very heavy in treasuries. Aside from lunch money speculations that I gladly share with you, I am sitting on the sideline and I'm using the Schwab feature to beat 3-month yields whenever I can. That is me. You do you. Remember, even a blind squirrel finds a nut. I did a week ago. Thank you for watching Yield Nerd.